Welcome to What the F Happened, Fraud and Financial Crime Deconstructed, a Defend podcast where we break down what's actually happening across fraud, scams, AML, and financial crime.
Each episode cuts through the noise to explain the tactics, trends, and real-world impact behind the headlines, so you're better prepared for what comes next. Let's get into it. Picture this. You have a $200,000 whole life insurance policy.
Right, a really solid safety net.
Yeah, exactly. You've been paying into it faithfully for, over 2 decades. It's a cash value policy, just sitting there quietly, building up this really comfortable nest egg.
Which is exactly what it's supposed to do.
Right, and in fact, it has been entirely untouched for 8 months. You haven't so much as, looked at the online portal.
Not even a glance.
Nope. Then, out of nowhere, suddenly a login happens. And within minutes, the profile's email address and the phone number are completely changed.
And just like that, the legitimate owner, meaning you're effectively locked out of your own financial life.
It's terrifying.
It really is. I mean, any alerts, any verification codes about what happens next, well, they're now going directly to the new contact info.
But the craziest part of this whole scenario isn't even the break-in itself, it's what happens next.
Right, the waiting game.
Exactly. The account goes completely dormant again. Days go by, just absolute silence. Then, a week later, the electronic funds transfer instructions are updated.
They swap out the banking details.
Yeah, the payout destination is changed to this untraceable mule account. And finally, the trap just snaps shut. A $180,000 surrender is requested.
Wow.
The money is cleared via same-day ACH, and it's just gone.
And meanwhile, the insurer's traditional fraud system, it just sits there completely quiet, doesn't even blink.
And not a single alarm?
Nope. Not until the next day during an automated batch review. And I mean, by the time that red flag finally goes up, the money has already settled in the new account.
The mule account has been drained.
Exactly. The thief is completely in the wind.
Man, that scenario is not just some hypothetical nightmare. It is actually happening right now. And it's exactly what we're untangling today.
It's a massive issue.
It really is. So welcome to the deep dive. Our mission today is to explore this massive, quiet threat that was outlined in a really fascinating piece by Pierre Eisense.
Yeah, his breakdown on life insurance account takeovers, or ATOs, is just incredible.
It really is. We're going to look at how the digital convenience that, let's be honest, we all demand nowadays has actually created these massive vulnerabilities for life insurers.
And of course, how AI is fundamentally changing the way our digital identities are protected.
Right, because it's a phenomenal subject to dig into. The target here isn't just, a simple $50 credit card charge that your bank will just refund with no questions asked.
No, not at all. We are talking about high-value policies holding decades of accumulated cash.
Life savings, basically.
Exactly. And the digital portals we use to access them, well, they were originally designed to just make your life easier. They weren't built to withstand adversarial military-grade cyber attacks.
So whether you are catching up on cybersecurity trends, maybe you're working in the fintech space, or you just have an old dormant policy sitting in some digital portal out there, this deep dive is going to reveal the fascinating kind of hidden layers of security that happen in the background of a simple login.
It's a lot more complex than just typing in a password.
It really is. So what does this all mean? How does 180 grand just slip through the cracks of a massive financial institution?
Well, to figure out why those traditional alarms failed so spectacularly in your opening story, we really have to break down the actual mechanics of the heist.
Right, how it actually goes down step by step.
Exactly, because this is not a smash-and-grab robbery where someone just kicks down the door. It is a highly choreographed, methodical process. Eisense actually refers to it as the ATO kill chain.
The ATO kill chain, I love that term. But I want to understand how this actually starts. Because if they're getting into an account that hasn't been touched in 8 months, they must have the password, right? Are they just sitting there guessing passwords until they get lucky?
Oh, no, not anymore. That would be far too noisy.
It would trigger lockouts, right?
Exactly. The attackers acquire credentials primarily through 2 incredibly effective methods now. The first one is automated credential stuffing.
Which is what, exactly?
Well, because human beings are notoriously bad at cybersecurity, we tend to reuse the same password for our secure insurance portal that we use for, a random online shoe store.
Guilty as charged. Yeah.
Right, we all do it. And when that shoe store gets breached, hackers buy those databases on the dark web. Then they use automated bot networks to rapidly test thousands of username and password combinations against the insurer's login page until one finally clicks.
That is terrifyingly simple, just recycling our bad habits.
Pretty much.
But the text also mentioned AI-assisted social engineering. How does that play into getting the password?
Yeah. That is the second method, and it's far more targeted. Attackers are now using generative AI to craft these highly sophisticated phishing campaigns.
So not just the badly spelled emails from a supposed prince anymore.
Not at all. Gone are those days. Now, AI can scrape the internet, find out who your specific insurance agent is, and generate an email that perfectly mimics their tone.
Oh, wow.
Yeah, they're formatting their email signature, everything. It tricks you into clicking a fake login link and just handing your password directly to the hackers.
Okay, so they have the key, they slip into the portal, this is their initial access, but usually they're logging in from a totally new device, right? Maybe even a new country. Why doesn't the system just boot them out immediately?
Well, because at this point, they haven't actually asked for any money.
Oh, right, they're just looking around.
Exactly. Their immediate goal is to establish control and blind the victim. They quietly change the email, the phone number, maybe even the physical mailing address. The entire strategy at this stage is alert suppression.
Ah, I see. Because if the insurer sends an automated message saying like, hey, did you just request a massive withdrawal? It goes straight to the attacker's inbox, not yours.
Yep. You remain completely oblivious.
But wait, wouldn't changing all of your contact info all at once look incredibly suspicious to the insurance company?
You hit the nail on the head. It absolutely does. And what's fascinating here is that this is exactly why the fraudsters don't take the money right away. They're actively manipulating the insurer's own internal rules.
How so?
You see, most life insurance companies have a mandatory 5 business day processing time.
Just a standard waiting period.
Right. They use this window to verify any new banking information before they'll allow funds to move. And furthermore, if a user changes their email, their phone number, and their banking information all in the same session,
That's got to be a massive red flag.
it is. That immediately triggers a severe high-risk alert. The fraud department will freeze the account and actually require a manual callback to the old, previously registered phone number to authenticate the request.
Which would completely ruin the heist because they'd be calling the real owner.
Exactly. The jig would be up.
Okay, let's unpack this. This isn't a smash and grab robbery. It's like a thief quietly changing the locks on your house, forwarding your mail to a new address, and then waiting weeks before backing a moving truck into the driveway so the neighbors don't suspect a thing.
That is the absolute best way to visualize it. They change the contact info, and then they exercise this incredible patience. They log out and let the account sit entirely dormant.
Just letting the dust settle.
Yeah, so that the newly updated email and phone number become the new normal in the system's eyes.
And then the moving truck finally arrives.
Precisely. After that cooling off period, they return for the payment rail setup. They update the bank payout instructions. Because they space these actions out over weeks, every single step looks perfectly legitimate when viewed in isolation.
It's so methodical.
It really is. And then comes the monetization event. They actually request the policy surrender, or maybe a massive loan.
And you mentioned earlier they use a mule account for this. Let's clarify that quickly for anyone unfamiliar. A mule account is basically a temporary, untraceable bank account, right?
Yes, exactly.
Often set up using stolen identities, specifically designed just to receive stolen funds and immediately wash them before the authorities can freeze anything.
That is exactly what it is. And that leads to the final step of the kill chain, the funds movement. They move the money using a system like same-day ACH.
Which means the automated clearinghouse network. It's basically how banks talk to each other to move money. And same day means exactly what it sounds like.
Yeah, the money transfers and settles in a matter of hours.
Making it nearly impossible to claw back once it's gone. Man, it is a brilliant, frighteningly patient strategy. But I am still hung up on the defense side of this.
The fraud systems, you mean?
Yeah. If this methodical pattern is so well documented by people like Eisenstein, why on earth do legacy fraud alarms fail to catch it?
Well, the answer really lies in the architecture of legacy systems and a concept we can call the digital self-service paradox. To really understand this, we have to look at why these portals were built in the first place.
Right, because for decades, if you wanted to change a beneficiary or request a policy loan, you had to call your insurance agent. You had to physically sign paperwork. There was a human being in the loop validating who you were.
Exactly. It was slow, but it was secure.
But insurers wanted to cut servicing costs, and customers, as we demanded the same 2047 digital convenience we get from like Amazon or Netflix.
Yeah.
So insurers built these massive online self-service portals.
Which is fantastic for customer experience, right? But the exact features that create that frictionless convenience, they also dramatically expand the attack surface.
Because it removes the human safety net.
Yes. An attacker with compromised credentials can now execute an entire sequence of complex insurance fraud purely digitally without ever speaking to a single human being.
Wait, if a policy has been totally inactive for 8 months, shouldn't a sudden login immediately trigger the biggest, loudest alarm bells in the system?
Yeah.
I feel like if I don't use a credit card for a year and then try to buy a television, my bank texts me in 3 seconds.
This raises an important question, actually, because you would naturally assume that. But that assumes life insurance works like your everyday checking account, and it fundamentally does not.
How so?
Well, in banking, customers log in frequently. They check their balances daily or weekly. They make dozens of small to medium transactions a month.
Right. Buying coffee, paying bills.
Exactly. This creates a very strong, continuous, and measurable behavioral baseline. So if you suddenly log in from a weird location and try to wire your entire checking balance to an unknown account, the banking system spots the anomaly instantly.
Right, because the bank has a massive data set of what my normal looks like.
But life insurance is a completely different beast. The counterintuitive reality here is that in life insurance, months or even years of total inactivity is actually completely normal behavior.
Really? Years?
Oh, absolutely. Policyholders treat it like a set-and-forget asset. They might only log in once a year during tax season, or perhaps during a major life event, like getting married or having a child.
So the silence is a feature, not a bug.
Exactly.
Yeah.
A long gap of silence before a sudden login isn't an anomaly at all. It's just the standard user journey. So traditional banking-style systems, which rely heavily on login frequency signals, are just completely blind to it.
And when a legitimate policyholder does finally log in and request a transaction, it's not a $50 dinner bill. It's usually a massive transaction, like taking out a loan for a down payment on a house.
Right, so a massive dollar amount isn't inherently suspicious either.
That makes a lot of sense. Now, the source outlines a few specific blind spots in traditional transaction monitoring that allow these attacks to succeed. The first is a lack of digital context. What does that mean in practice?
It means traditional fraud systems ingest these sanitized, flattened transaction records.
Sanitized, like stripped of details.
Yeah. When a surrender request is made, the legacy system just sees a data packet that says, amount, $180,000, destination, this routing number. What it absolutely does not see is the rich digital context of how that request was initiated. It doesn't see the device fingerprint. It doesn't know if the browser environment is suspicious.
It's just looking at the math.
Exactly. It doesn't check the IP reputation or measure the user's typing cadence. It simply sees a mathematically valid request originating from an authenticated account.
And that leads directly to the second blind spot, which is that detection happens way too late in the workflow.
Way too late.
The traditional system is only designed to evaluate the final transaction. It's only looking at the very end of that kill chain we discussed.
Stage 5 or 6.
Right. By the time it looks at the payout request, the contact info has already been changed, the new banking rails are established, and the multi-factor authentication has been satisfied by the hacker's phone.
They've already built the entire trap.
Exactly. The system is evaluating a fully constructed, entirely legitimate-looking payout instead of flagging the highly suspicious session behavior that actually built that trap weeks ago.
Spot on. And then the third fatal flaw is batch decisioning.
Batch decisioning, meaning what?
It's basically a relic of older mainframe computer systems that, surprisingly, many large financial institutions still rely on. These systems weren't built for the real-time internet age.
So they don't process things instantly?
No, not at all. Instead of analyzing transactions the millisecond they occur, they queue up thousands of requests throughout the day and then run a massive batch analysis overnight.
So wait, if the hacker initiates the transfer at 10:00 a.m. and the money moves out via same-day ACH by 2:00 p.m., the system doesn't even run its fraud check until 2:00 a.m. the next morning.
Exactly the problem. By the time the batch review flags the transaction as suspicious, the money is literally already gone. Fraud detection essentially devolves into post-event loss identification rather than actual prevention.
Man, it's like the fire alarm only going off after the building is already burned to the ground. It is completely useless for saving the structure.
It really is.
So, if traditional transaction rules are blind to context, they look way too late in the process and they move far too slowly. How do we actually stop this? The industry clearly has to shift to looking at how a user behaves, not just what they are doing.
Yes, exactly.
And this brings us to the technological shift that is completely changing the game.
We're talking about artificial intelligence here, and more specifically, unsupervised machine learning.
Okay, break that down for us.
Sure. So for decades, fraud detection was built around static rules and supervised models that were trained entirely on known historical fraud patterns.
Like a checklist of past crimes.
Exactly. It was essentially a giant, rigid checklist.
Hmm.
Does this transaction match these 5 known bad indicators we saw last year? But as we've seen, a life insurance account takeover unfolds across a sequence of actions that appear perfectly legitimate. They just don't match the historical checklist of a smash and grab.
So you can't rely on a checklist of known bad behaviors. You need something that understands what normal looks like and raises a flag when something simply doesn't fit, even if it's a brand new tactic.
Yeah. That is the power of unsupervised machine learning. These AI models analyze massive, continuous volumes of data to identify patterns that deviate from normal behavior, even if those specific patterns haven't previously been labeled as fraud by a human analyst.
So it's adapting on the fly.
Yes. Instead of asking, is this a known attack? The AI asks, does this sequence of events mathematically fit the expected behavior of a legitimate policyholder?
But wait, how does an AI know what my normal behavior is if, as we established earlier, I only log into my life insurance portal once a year?
Ah, that is where session-level monitoring and passive biometrics come into play. The AI isn't just looking at what you click, it is analyzing the microscopic details of how you interact with the digital environment.
Okay, give me an example of passive biometrics, because when I hear biometrics, I think of like scanning my thumbprint or my face to unlock my phone.
Right, those are active biometrics. Think of passive biometrics as your behavioral fingerprint. The AI measures things like the exact milliseconds of flight time between your keystrokes. It analyzes how much your mouse jitters as you navigate a page.
Wow, really? It's that granular?
Oh, absolutely.
Yeah.
If you are on a smartphone, it can measure the specific angle you typically hold your device or the pressure of your taps.
That's wild.
It is, because a human being has a natural, slightly chaotic rhythm. But a credential stuffing bot or a fraudster frantically copying and pasting information from a spreadsheet, they have a completely different, highly mechanical rhythm. The AI sees that difference instantly.
It also looks at environmental context, right? Things like IP reputation and possible travel scenarios. Like if my account is logged into from a coffee shop in New York and then 10 minutes later it's accessed from a server in Eastern Europe, the AI knows human physics makes that impossible.
Precisely. The AI correlates all of these seemingly disparate data points. It sees the whole picture.
Putting the puzzle pieces together?
Exactly. It says, okay, a device we've never seen before accessed a policy after 8 months of total inactivity. The user's typing cadence was highly mechanical. They immediately navigated to the settings page, rapidly changed the email and phone number, and then logged out.
And any one of those might be fine on its own.
Right. Individually, any one of those actions might be explainable.
Yeah.
Correlated together, though, the AI recognizes with a high degree of mathematical certainty that the policy is being controlled by a hostile actor.
Here's where it gets really interesting. Think about the old way, the static rules, as a bouncer at a casino.
Okay, I like this.
The bouncer checks to see if your ID scans at the front door. The ID is valid, the password works, so you're in. But once you're inside the casino, that bouncer isn't paying attention to you anymore. You can basically do whatever you want.
Right, you have free reign.
But the AI approach, that is like a highly trained casino pit boss. The pit boss doesn't just care that you got through the door. They are actively watching your eye movements. They're noticing if you're nervously sweating. They are analyzing exactly how you handle your chips at the blackjack table and tracking who you're whispering to on the floor. It's continuous behavioral observation from the moment you walk in until the moment you leave.
I love that analogy because it highlights the most important shift here. Proactive intervention. If we connect this to the bigger picture, this continuous behavioral context is what allows insurers to implement real-time decisioning.
Acting in the moment.
Exactly. If the AI pit boss detects that highly suspicious sequence of events during the session, it can intervene before the money ever leaves the institution. It doesn't have to wait for the overnight batch process.
It just stops it right there.
Yep. It can instantly trigger step-up authentication, it can demand a live video verification, or it can simply freeze the transaction and route it to a human investigator.
It stops the moving truck before the thieves can even put the car in drive. But, and I assume there's a big but here, there is a massive operational catch, right? AI isn't just magic fairy dust. You can sprinkle on a legacy 1990s computer system to suddenly fix everything.
No, not at all. AI is entirely dependent on the data it is fed. It relies fundamentally on having a modern data architecture.
So the foundation has to be there first.
Exactly. If an insurer's core system is still only capable of capturing and ingesting those sanitized, purely financial transaction records, the ones that just show the dollar amount and the routing number, the AI is going to be completely blind.
Because it can't see the behavior.
Right. You cannot analyze a user's typing cadence if your system isn't built to capture keystroke telemetry in the first place. AI is only effective when it's paired with real-time visibility into the granular interaction-level activity of the digital policyholder.
So we have walked through how this quiet digital heist operates, why the legacy alarms sleep right through it, and how AI pit bosses are stepping in to actively monitor the casino floor. But let's bring this all back to you, the listener. Why does this intricate technological dance matter for the future of digital business? And honestly, more importantly, for your own personal security?
Well, it matters because the industry is being forced to completely reframe how it views fraud prevention. For a very long time, fraud prevention was viewed strictly as a defensive back-office function.
Just putting out fires.
Yeah, it was just loss mitigation, a necessary cost of doing business. But as vast amounts of wealth move into digital self-service channels, advanced fraud prevention is actually becoming a massive growth lever for these companies.
A growth lever, meaning it actually helps them make money.
Indirectly, yes, because it builds the one currency that matters: trust. Without absolute trust, policyholders simply will not use digital self-service for high-value assets. I mean, if you are terrified that your life savings could be drained by a hacker in a matter of hours, you will refuse to use the online portal.
True, I'd definitely be calling my agent.
Exactly. You'll demand to speak to live agents, you'll insist on mailing physical paper forms, and all the operational efficiencies and cost savings the insurer hoped to gain from going digital will instantly evaporate. By utilizing AI to secure these channels invisibly and effectively, insurers can confidently expand their digital offerings. Strong security builds customer trust, trust drives digital adoption, and adoption scales the business.
It creates a virtuous cycle. And as a consumer, as you navigate your own digital life, you are constantly benefiting from these invisible layers of behavioral intelligence.
You don't even see it happening.
Right. Every single time you log into a banking app from your couch and it doesn't force you to enter a cumbersome two-factor authentication code, it's likely because an AI in the background recognized your specific smartphone, your home Wi-Fi network, and your behavioral baseline, and just silently decided you were safe.
It's working for you.
But it's also a fantastic reminder of why keeping an eye on your long dormant accounts is so incredibly crucial. Don't let your old policies just sit in the dark for years on end. Log in occasionally, establish your normal baseline, make it that much harder for the bad guys to blend in.
I couldn't agree more. The landscape is shifting at breakneck speed. The attacks are getting vastly more sophisticated, but thankfully the behavioral defenses are evolving right alongside them.
Which brings up a really fascinating tension mentioned at the very end of Pierre Eisenstein's research. We talked about how attackers are now weaponizing generative AI to create highly sophisticated phishing campaigns and scaling their attacks at a machine speed that humans could just never match.
And on the flip side, defenders are relying on unsupervised machine learning to analyze microscopic behavioral anomalies in milliseconds. We are effectively watching an AI versus AI arms race unfold in real time.
But here is the massive paradox. Regulators, specifically groups like the National Association of Insurance Commissioners, the NAIC, are increasingly demanding human oversight as a core principle for responsible AI deployment in the financial sector.
They want a person making the final call.
Exactly. They explicitly want humans kept in the loop when these systems make decisions.
Which is an understandable safeguard, of course, but it creates a tremendous operational bottleneck when you are fighting machine speed attacks.
Exactly. So I want to leave you with this final lingering question to mull over. If we're entering a digital arms race where AI perfectly mimics human behavior to launch a lightning-fast attack, and AI perfectly analyzes complex behavioral patterns in milliseconds to defend against it, will mandated human oversight eventually become the very bottleneck that causes us to lose the war? If the thief has already changed the locks and the moving truck is in the driveway, can we really afford to wait for a human being to review the paperwork before we stop them? Something to ponder long after this deep dive ends. Till next time.
You've been listening to What the F Happened? Fraud and Financial Crime Deconstructed, a Defend podcast by DataVisor. If you want to keep learning between episodes, check out Defend Training, a set of self-paced online courses for fraud and financial crime professionals, practical and built around real-world scenarios.
And you can earn CPE credits through the ACFE San Francisco Bay Area chapter. You can find it at datavisor.com/defendtraining. The link's in the description.
This episode's audio was generated using Google's Notebook LM, based on expert analysis and trusted sources. Thanks for listening. We'll see you next time.